Mavericks owner and billionaire investor Mark Cuban telling our own Deirdre Bolton yesterday that high-frequency trading is what is setting today apart from the market fall of 2008. Take a listen.
I think this is new territory for everybody. You know, everybody always laughs when you say this time it's different, but in 2008, we didn't have high-frequency trading the way we have it today.
Joining the conversation is Deutsche Bank Chief U.S. Equity Strategist David Bianco, and I want to get your reaction first to Mark Cuban's comments. Good morning.
Actually, there've always been frequent trading in the market. You see it in different spots. You don't see the first responders in the market on Wall Street, and that might be a problem. We saw some dislocations in big market cap stocks and ETFs. I think if you had more desks on Wall Street ready to respond, they're sitting there every day ready to do this.
So is high-frequency trading helping or hurting the equity markets?
Honestly, high-frequency trading is a bit of a distraction for what's going on. This is all about China, but I can understand why it's limiting confidence, but that's probably an opportunity.
I want to raise that about the ETFs, a story that we were on top of on Monday when these mispricings were first showing up, a story we were all over yesterday. You have, by estimates, 1 in 4 major ETFs, major multi-billion-dollar ETFs that had mispricings of 20 to 50% because the market makers basically said we can't price the underlying, and they stepped away. They were basically lowballing the buys, and they were overpricing their sells. And these are people, these are individuals who were sold these things, saying, oh, they're better than mutual funds. What does that do to confidence?
Look, we were watching that all of Monday as well, and there were dislocations in big cap stocks, and there were wide disconnects between ETFs and the underlying indices.
Right.
I wouldn't characterize it as mispricings. These were trades that cleared in a market setting. There was a buyer and seller. They were matched.
But that's
but I can understand that people were frustrated.
But see, that's not what people expected. They think these things operate like mutual funds.
Understood.
That it should be priced based on the underlying, and it wasn't. These are dividend ETFs. These are low volatility ETFs that are some of the biggest in the market. And that will. Do you see a shift to mutual? I'm just saying that this is a story. It's in the Journal today, being downplayed in terms of the market.
And it's something we highlighted in our research note last night, and it was something we were talking about on Monday, and we recognize this as a shock to confidence, not just for individual investors, but even for institutions. Institutions use ETFs very much nowadays.
Big time.
Look, I think what you need to know is that we've got a market that's wrestling with a lot of incoming data, particularly out of the commodity complex and currencies. I often describe it, we're not worried that China is going to disappear or plunge into a nasty recession. We're worried about countries and companies that sell to China and a lot of profit pressures that are there.
How exposed is the U.S. stock market to China's?
The S&P 500 is exposed to China and the global economy. I'm somebody who's been arguing this for a long time. Only 5% of S&P profits come from China. 15% of S&P profits come from
but how are you saying that
economies.
this sell-off is all China then? Makes sense of that.
Because China dominates the commodity complex.
Okay.
And China's become a big part of the strength in the dollar now that we see it versus emerging currencies. And the reason is that there's fear that the renminbi will be depreciated further.
How much of it do you think is that, a lot of people like to blame, we're U.S. navel gazers, we all like to blame everyone but ourselves. It's just a fundamental problem that we have as human beings. What do you think about the U.S.?
Yeah.
Late cycle 2000, late cycle 2007, late cycle, this is my call, but 2015. What if 3 to 6 months from now the jobs market goes from, let's argue it's kind of good to bad? What is the market telling us about the U.S. economy?
Well, we think we're in a mid-cycle environment for a lot of reasons, but a point worth making is this does not seem like early cycle Fed hiking at this stage. We think the Fed will be hiking. Eventually, it's probably only a matter of 6 months away, if not less. But we think the Fed will be hiking because the labor market is tightening, not because the U.S. economy is booming. And a tightening labor market driving Fed hikes is something that can cause the dollar to strengthen more.
David Bianco, Deutsche Bank Chief U.S. Equity Analyst. You're going to